Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, October 11th, 2023, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and I am going to take this opportunity to dabble in earnings trades. It is the start of the third quarter earnings season here in 2023, and we have had a little bit of a market dip that has driven volatility up, and there's a lot of uncertainty around earnings, and that really breeds a lot of options premium, which is my number one favorite thing to trade. And so this episode, I am going to call out an earnings trade that I put on today in Walgreens. But first, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Sprocket, several of the other Blockhead traders. We love to hear from you, love to hear what type of content you're interested in and what type of trading you've got going on. You also find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, Blockhead Traders, and let us know if you can't find it wherever you get your podcasts, and we will get it there. So on to the content of this week's episode. Like I mentioned, it is pretty much the start of Q3 earnings season, and there has been quite a bit of market volatility. The market has been in a bit of a slide for the past several weeks. Actually, it just started pulling out after seemingly at this moment, seeming to find a bottom last Friday. There's quite a few rallies this week. And it could just be everybody's really hyped up about earnings and they're maybe not going to be as bad as people thought. Whatever the reason might be, it seems to be coming off a little bit of its low. However, on the way down there, we were able to pick up quite a bit of volatility. And it takes just a little bit of time for the market to kind of bleed off that volatility. And one of the other sources of volatility that we've talked about numerous times on this episode or on this show is the volatility leading up to earnings. Remember, earnings is a binary event. And so different people like to play it different ways. I consider earnings a great way to look for stocks that are extra elevated on volatility. Because typically what happens after an earnings announcement is a lot of that volatility is leading up to the uncertainty of earnings. And as soon as that certainty is known, that volatility contracts and deflates like a massive balloon. And that is what I like to try to profit off of. So I sell the volatility while it is high, and then I kind of bank on earnings staying within a particular range or going in a certain direction, depending on what type of trade I put on. And I'm looking for that volatility to absolutely deflate and contract as soon as earnings are out there. And then I buy back my options once that earnings premium has dropped, and I'm basically pocket the difference. It's very similar to shorting a stock where you're betting that the price will go down. The difference here is the price of the option, at least the extrinsic value of the option, is guaranteed to go down. Now, the option price can still go up if you breach your strikes and kind of go into the money, but options by nature will go to zero at expiration. And so that premium that I sell will go to zero, assuming the option stays out of the money, because I'm selling out of the money options. And earnings is one of those things where if you picture that balloon, volatility is the air in the balloon. And leading up to earnings, somebody is really pumping that balloon full of air because there's a lot of uncertainty and there's a lot of price movement in a lot of the underlyings, which drives up the volatility. As soon as earnings come out, there's not as much uncertainty. And so that volatility comes down a ton and the air is basically coming out of the balloon. And that's effectively what I like to sell. And I decided that as earnings are starting to pick up, looking for a little bit of excitement, I thought I'd go looking for an earnings play. When it's time for me to go looking for an earnings play, I'm going to hop to my screener. And we've gone over this before, but I'll just give a quick rundown here of the screener that I like to use. So this is a screener. You can replicate these criteria in whatever you like to trade in. I'm sure these parameters are available. The first thing I filter by here is closing price. And so what I mean by that is I don't want really stocks that are kind of below $10. So I'm cool with any kind of stock from $10 up to as big as they can get. I'll probably end up tending to do something in the $20 to $70 range, but I will play earnings with underlyings as much as $140 or $150. The next thing is I look for that volatility index. And so I want at least 30% spot volatility, which means the volatility in the name right now needs to be at least 30%. Now, most of the time I'm going to find something that's higher than that, but that's kind of the minimum criteria. Much below that in my experience, it's never really worth the effort or the risk there. The juice isn't worth the squeeze, as they say. So then I look for IV percentile. Now, IV percentile is one of the values that I care about the most. And on earnings time, because there's not a ton of earnings out there, I don't limit this. And so that's why you see it set 0 to 200 here. But if there were a lot of values, I would start raising this up. Most of the time, I want at least 50% IV percentile. And what that is actually saying is, of the past 52 weeks, what percentage of the time has volatility been lower than where it is now? So this is the particular percentile that the volatility is in with respect to the last 52 weeks. And so an IV percentile of something like 80 would say that 80%, it's 80% higher than the range. It's in the top 20%, or 80% of the time, volatility has been lower than where it is now. And so that's a very extended. And the IV percentile is really that thing that's going to tell me how stretched is this. Next thing, I just looked for earnings. In this case, I'm looking for earnings in the next 8 days. And I want average volume to be pretty high. So I want to say over the last 5 periods, in this case, this is set to days. Over the last 5 days, I want at least 1 million shares of volume in the underlying. The reason I do that is because sometimes lower volume things will show up on these screeners because they'll hit some of the other criteria. But if volume is not up, then the liquidity won't be there, and I just don't want to touch those. And so that's a second very important. So IV percentile and volume are probably the 2 most important values in this screener. I have another one here for earnings has any time in the next 3 days. Now, normally I do. One of them does not have in like the next day, or maybe I say in the next whatever days, and the top one is the next so many days. So I can kind of narrow that range of earnings that I'm looking at. So I'll try to tweak that so I get the earnings for next week or the week of, and that helps me kind of, plot out what day do I want to put what trade on. And I can line up a bunch of these earnings trades, because what usually happens is I cash out the day of the earnings. And then that day, if there's another earnings coming up the following day, I can recycle those funds and go another round in the earnings game. So this screener, you can see, has pulled up just a handful of stocks, not too many. I sorted them by IV percentile, and you'll see my number one hit that I decided to play today was WBA, or Walgreens. And you can see here it has an IV percentile of 86.79. That is uber elevated. This says that only 86.79% of the time volatility in the past year has been lower than it is right now. That's a great sign. And then the next thing I look at is this volume of 17 million shares traded today. That is excellent, because that means we got a lot of liquidity. So getting in and out of this is not likely to be a problem. And then the underlying is trading around 2260, which is also awesome, because remember, when I go into these trades, I almost always will do them with naked, which means I don't have any protection legs. And that's important, because if I get assigned, I want to be able to hold the stock long or short, whichever side of my strikes get breached. And it's important to have something that's a lower number for me and my portfolio size, because I will be doing 100 shares of these for every options contract that I trade. And so I need to be able to be okay with assignment. That is one of my rules going into earnings or into any option premium selling play, is you must be okay with assignment of the stock. If you are not okay with being assigned, then do not enter these trades. So the next thing I kind of want to look at is the chart. So if we kind of switch gears here and we move over to the chart, this is I typically, when I'm looking at earnings trades, I'm going to pull up the daily chart. And so what we got here is a chart of the daily. Walgreens has just been on this epic slide effectively for the past year. And we kind of reached a low here at the end of September, and we kind of started to rally up. But we're kind of pushing up against some of these moving averages. I don't really pay too much attention to the price action on these earnings trades because I'm really kind of looking for a very quick in and out overnight type trade. I do care a little bit about them because they do help me judge where I most likely have the most risk. In this particular thing, because it's starting to kind of come back up, because we're approaching that catalyst moment, that binary event, there is a little bit of a concern that this could breach the top side of my strikes. And that's where I kind of have to gauge this. And I'm like, okay, look, if it breaches the top side of the strike, how likely is it to stay well above that strike? Or can I maybe hang on to it for a little bit to see if I can wait for that to contract back down? Because there's been such in this case, pretty strong downtrend. And so, you never can be certain. But for me, it seems probabilistic that if we were to breach on the high side, there is a likely chance that this will end up coming back in post earnings. Now, will it happen before expiration? Don't know. But that's really where you have to be okay with assignment. And we'll talk a little bit later about the management of this, which is the rolling of these particular options once earnings are out, if you get into trouble. Now, the important thing I want to call out here, and this is the thing that really got me to say, yes, I am going to take this trade. I have this chart here, and what this chart is, it's kind of red and green. It's kind of Christmassy. What this chart is showing is the implied volatility, the IV rank over time. Red is basically where it's below 50%, and anytime it gets green, it's above 50% IV percentile and or IV rank. And so in this particular case, you can see we really went green here where volatility got really high, and this is where we are, just excellently elevated. And if I look over here, we got an IV rank of 87% and IV percentile of 97. So 97% of the days before today were less than the current IV. And so you can see like way, way, way back here was the only time we've really been higher, and it was just a little bit nudge higher. And if you want to see what I'm talking about when these earnings things come out, you can look right here where you got this earnings announcement and we got a drop off, and you get a little bit of a drop in the cliff here as far as the volatility goes. So what does this kind of look like if we look mechanically at the spread here? And so if I switch over to the view of this particular strangle. So what I did was I did a 17 delta strangle. So I looked at the option prices and I took a 17 delta put and a 17 delta call. What that basically means is the delta is effectively the percent of chance that it will be in the money. So there's a 17% chance that it'll be in the money on the bottom side and a 17% chance that it'll be in the money on the top side. And that is where you get this kind of blue line is where the value of this option will be at expiration. These little red ticks right here, just close to these outside dashed lines, this is my break-even part. And so these then dashed lines is basically a 10% move in the stock. So this center line is where the stock price is right now. This blue line is my profit and graph based on the put that I sold at $20 and the put and the call that I sold at $24.50 up here. And so I had collected 44 cents between the two of those strikes. And I actually did 5 contracts. So that's basically 500 shares, 44 cents each contract. And I did 5 of them. So I collected $220 on this. And you can see this this purple line, this purple arc. This is the value of the options right now. This is my P&L right now on this. Now, the market is closed, and this is a little goofy because the option price is closed a little bit funny, but this purple line will basically start to close up over time to this blue line. Now, my options will expire this Friday. So it's Wednesday. The earnings will be out tomorrow before the bell. And then basically by Friday close, the extrinsic value of this option has to go to 0. And so the theta that's presently in these options is $84. Now, this is where it's a little bit goofy because this is after the market closed. Just before the market closed, this purple line was quite a bit up higher. It's because the price is closed at a goofy closure, and they get locked in. They'll immediately correct and they open tomorrow. But what I'm banking on is I'm banking on the price of Walgreens to stay above this $20.50 and below this almost $25. And as long as it stays between those, that is profit for me. If we happen to breach past this strike, I will risk assignment. So I could be short 500 shares or long 500 shares, depending on which side the earnings fall at expiration. So on Friday. So I have till Friday at close for this price to kind of normalize before assignment happens. There's always a chance of an early assignment, but for this, we're not going to touch on that. And that's where I will decide what to do when that comes as we get close. Now, the ideal case is earnings keep the stock right between these strikes. So it opens up probably about an hour or two into the open. Volatility goes, and this purple line comes way up. I can close this out. My target is always 50% of the premium that I collected. So I collected $220 in premium. If I can close it out for $110, I will. That is a $110 profit in basically overnight. That's about all there is to an earnings trade. I scan during earnings season for things that have that really extreme volatility hike. I have experimented in the past by just playing earnings in general, just saying, hey, here's earnings. I'm going to be in 2-3 earnings trades a day, pop. Just pick them, whatever looks interesting. And I don't pre-screen for that elevated volatility. Well, you can come out a winner. I have noticed that my success rate is much greater if I look for that overextended volatility heading into earnings. So you're kind of increasing your probability of success because you're starting with something that's already extra extended, going into a binary event where the outcome is always contraction of that volatility because uncertainty is gone. So in this example, today I sold the 21 short put and the 24.50 short call. That netted me a total of 44 cents. In this case, it's a batch of 100. So that was $44. I actually did that with 5 contracts. So it was 44 cents per contract. And I sold 5 of those contracts. It consumed about 2.3K in buying power. So that's the capital that I have tied up on this trade. So a return on capital is what percentage of that can I make on the premium collected. And so in this case, I collected $220. I had to put up 2.3K to make the trade. That is roughly a 9.6% gain as a return on capital. Now, I will get out at 50% of that, so you can think of that more like a 4.7% return on capital if that pans out. And you might think, well, that's not too bad. I can go buy treasuries for like 5.25. Why would I dabble with this? Remember, this is overnight because this is a binary event. This thing will be said and done tomorrow after the bell opens, and that type of percentage return on an overnight trade is pretty nice to have. So that is the end of the content that I have for this week's episode. I'm going to close it out here just as a recap with numbers here associated with it. This is my short strangle on Walgreens. Effectively, I took it at 17 delta strikes. I always typically start looking at 16 delta. I will kind of go as high as 20 delta, but not much more. when I'm looking at a strangle, because you're basically burning the candle at both ends. If I'm playing earnings from put side or the call side, I will go up to almost a 35 delta. But when I'm splitting it in a strangle, pretty much it's 16 to 20, maybe 25 delta, but that's pretty rare. I also never really play earnings only from the call side. So my two earnings trades are typically a put only because I'm much more comfortable selling puts, because then you get assigned, you end up long the shares. Most of the time, stocks eventually go up. So while you could get beat on earnings and crushed, your consolation prize is you keep the premium and you own the shares, so you can sell calls against them in the future. That I'm much more comfortable with. So I will sell just puts going into earnings. Like I said, I will do strangles, but just calls I never really do, because one, it's usually pretty hard to do. Because if you have a decent premium there and you try to go for the call, you're really getting battled against you, because if the premium's worth it on the call side, it probably means the stock is in an uptrend. So there's a lot more risk to the upside. So you have a much higher chance of being breached. And the more the stock kind of goes up, the more the volatility comes down. So it never usually works out the way that you think it should. So I typically will never play earnings on just the call side. It's either a put or a strangle. Remember, never get into these things if you do not want to assign the shares, because these earnings announcements are always before or after the bell. They are when the market is not open. So whatever happens, that share price and aftermarkets are going to bounce around and you are stuck with your options. You cannot get rid of options until the market opens. There is no after hours trading for options. And so you will kind of sit and you will watch the stock price bounce all around after hours in the low volume, low whatever it is, and just kind of wondering what's going to happen. Is it going to stick up there? Is it going to stick down there? Whichever direction it goes. I personally find it kind of fun to watch. But if it's the first time you've done something like that, you might find it incredibly nerve-wracking, depending on your risk tolerance. So be cognizant of that. Otherwise, that's what I've got going on. Hopefully you find trades that you're interested in, and I wish you the best of luck out there. It's getting exciting here as we enter the third quarter earnings season. So good luck, have fun, and remember, think outside the block.